So in our last class, we started with risk and uncertainty, and I mentioned to you that, of course, after explanation of the expected value method, as well as the standard deviation and coefficient of variation, we had an illustration. We did only one illustration, so we could not continue because of time. So today we are going to continue from where we stopped. All right. Now, with like I'll explain to you, whenever you are asked to compute standard deviation of expected NPV, there are two different formulas that you can use to calculate the standard deviation of expected NPV, depending on the depending on the nature of the cash inflow. I explained to you that if you are given mutually dependent cash flows, then the standard deviation of NPV can be calculated as the standard deviation computed, all right? Standard deviation computed multiplied by annuity factor, okay? Multiplied by annuity factor. Okay, so this is one formula that you can use to compute standard deviation of NPV. So if it is mutually dependent, this is what you're supposed to do. And I always advise students that use this particular formula to calculate your standard deviation of NPV if you are given mutually dependent cash flow. Because if you are to use this one, it's to waste your time. Because if you want to use this one, you are going to do for all the relevant years. Say, for example, you are given, the project has about 5 years life. That means you just say standard deviation divided by 1 plus R raised to power discount factor of year 1 plus the standard deviation multiplied by 1 plus 1, the discount factor of year 2. You continue to do it like that until you get to the final year, okay? When you get to the final year, you now add everything together. It's a waste of time. So you are still doing this one. You are still using this method. I've already gotten my answer and I've moved to the next question. So I thought because this denominator, which is discount factor, when you add it together, it will give you the annuity factor. So why don't you just calculate annuity factor once and for all, then multiply with the standard deviation. So you move on from there. So please watch out. Then I also explained that if you are given mutually dependent cash flow, after explaining the formula, I also told you what is meant by mutually dependent cash flow. And I said the mutually dependent cash flow is the one in which the events in each year are the same. So if you are given the same cash flow across all the years, year 1, year 2, year 3, up to the final year, we are given the same cash flows. It means that the cash flows are mutually dependent. But where the cash flow are different, where you are given independent cash flows, that is the cash flow of each year are different. In this case, the formula you are going to use to calculate the standard deviation of expected NPV is this one. All right, and I told you that independent cash flow independent cash flows are standalone cash flows in which the events in each year are different, right? So once the cash flow of each year are different, then it is independent cash flow. And this is the formula we are going to use to compute the standard deviation of NPV. Now, in the last class, we solved a question under standard deviation and then expected value. So quickly, because of time, let's go to that. Let me just, I want to see I think this is the question we solved, illustration number 5. Esther, can you confirm? Is it this question we solved? Esther?
Yes, yes, sir.
So if it is this question we solved, so you can see that the cash flow of this year 1 is different from cash flow of year 2, is different from cash flow of year 3. So that means they are independent. And that's why you see here, examiner told you that the events of each year are independent of other years. So this is the one we solved. So let's have one more illustration under the standard deviation before we move to the next one. So let's solve the one that have mutually dependent cash flow. So let's have this illustration number 6. All right, I will read. Justin Limited is considering whether to invest in a project which will entail immediate capital expenditure on capital investments, so on capital equipment, worth, sorry, on, let me start again. Justin Limited is considering whether to invest in a project that will entail immediate capital expenditure on equipment worth 40,000 naira. That's the initial outlay. The expected sales volume from the project are given below. These are the sales volumes with the probability. The unit selling price is 15 naira. Variable cost per unit is 9 naira. Once sales are established at a certain volume in the first year, they will continue at that same volume in the subsequent year. So which means that they are mutually dependent. They are mutually dependent. Okay. The useful life of the project is 6 years, and the equipment will be sold for 5,000 naira after the end of the project. So this represents the scrap value. This is 5,000 naira is the scrap value. The company cost of capital is 10%. You are required to calculate the expected net present value of the project, the standard deviation of the NPV, and then the coefficient of variation. Now, so we have established from this question that the cash flows, in fact, in this particular question, you are not given a cash flow. All right, you are not given cash flow. You are only given sales volume. So you need to calculate first thing first. You need to calculate the cash flow. How do you then calculate cash flow in this question? Examiner has given to you selling price to be 15 naira. You are given variable costs to be 9 naira. Therefore, you need to calculate annual depreciation. So annual contribution. So you calculate contribution per unit. So if that is the case, so in fact, let me stop sharing this and move to the working notes so that we can solve as many questions as possible. Okay. The name of the company is Justin. So solution. So illustration number 6. That's page, let me check. Page 88. All right. So the name of the company is Justin Limited. So examiner is asking you to calculate the expected NPV. So you can't just jump to calculating the expected NPV. Ordinarily, when you want to calculate expected NPV, the first thing you are supposed to do is to calculate expected value. Then you now use your expected value to go and calculate the NPV. The result is known as expected NPV. However, in this particular question, we are given probability and the sales volume. We don't have cash flow. Therefore, first thing first, you need to calculate the cash flow. So I will then go and do workings. So don't forget, working is supposed to be the last thing you are supposed to come on on your last page. Your main solution will come on the main page. All right, but for the purpose of this class, let's just continue. So I will calculate contribution. We want to determine contribution. Contribution equal to selling price minus variable cost per unit. Selling price according to the question is 15 naira. Variable cost is 9 naira. Therefore, contribution per unit is 6 naira. Then we don't determine total contribution. We calculate total contribution. So we have the sales volume. We have the contribution per unit. Then we have the total contribution. So give me the sales volume, please. Are you there? What's the sales volume?
2,000.
2,000 units. Next one. Pardon?
Mr. Joe,
Yes.
please, good evening, sir. I just joined the class. What's the page so that I can be following you, sir?
Page 88.
Page what's up?
88.
All right, thank you.
So after 2,000 units, what's the next one?
1,008.
18. Next.
15.
Next.
25.
25. And the last one?
1,000.
1,000. So these are the sales volume. So you now multiply, you now get, of course, the contribution per unit is 6 naira as we computed. So multiply, this will give us 12,000. 1,800 multiplied by 6, what do you have?
10,800.
10,800. 15 multiplied by 6.
9,000.
25 multiplied by 6. 15,000. Then here will be 6,000. So we have calculated the cash flow now. So at this point, the next thing we need to do is to now calculate expected value. So I'm going to match, let me see, 1, 2, 3, 4, 5. This cannot contain the, so let's start from here. So I want to calculate, remember, in the requirements, examiner wants you to calculate expected NPV. So you cannot get expected NPV without first of all calculating the expected value. Therefore, I need to calculate expected value first. Calculating expected value. Also, examiner wants us to calculate standard deviation of NP and variance. All right. So the first column will be for the probability, followed by the cash flow, followed by expected value. This is P, this is X. Now, because we want to calculate variance, we need to extend the table. So this will then be X minus X bar. X bar is the expected value. Then X minus X bar all square. Then probability of X minus X bar square. All right. So give me the probability that's given in the question. 0 points.
0.15.
0.15.
0.20. 0.35. 0.10.
And the last one?
0.20.
20. Please, at all time, your probability must be equal to 1. Very important. Because if your probability is not equal to 1, you cannot have optimal solution. Then the cash flow we computed. The first one is 12,000 naira. So here is 12,000, followed by 10,800, 9,000, 15,000, then 6,000. To now get the expected value, which is X bar, we are supposed to multiply probability. You recall that expected value, which is X bar, is computed as summation of probability of X. That is, you multiply probability with the cash flow. So the first one, 0.15, 0.15 multiplied by 12,000. What do you have?
It's 1,800.
1,800. Next one.
2,160.
2,160. Next one.
3150.
3150. 15.
1500.
Then 1,200. So you add up the expected value. What do you have?
9810.
9,810. That represents the expected value. So this 9,810 will be for year 1, year 2, year 3, up to year 6 is the same amount because they are mutually dependent. So to now get the variance, all you need to do, of course, you know that variance is calculated as, this is variance, is calculated as summation of probability of x minus x bar square. And this formula is what we extended today to get to this point. So to get the variance, first thing first, this is x. You are going to minus the cash flow from the expected value. 12,000 minus 9,810. What you got? What do you have?
2190.
2,190. 2,190 squared. What do you have?
Okay. I have 4796.
4796.
100.
100. Then what you have in your calculator multiplied by probability of 0.15. What do you have?
Okay. I have 719.
Okay.
415.
415. So that represents the variance of the first one. Then the second one, 10,800 minus 9,810. What do you have?
I have 990.
990 squared.
I have 890. 100.
890, 100. Multiplied by probability of 0.2.
196. 2202. Yeah.
Hello, sir.
Yes?
990 squared is wrong. It's meant to be 980, 100.
Oh, sorry.
980,
I call
100.
980. 100.
Okay. 980.
100.
980. 980, 100. So multiply by 0.2.
196020.
196,020. Then the third one, 9,000 minus 9,810. That's minus 810. Minus 810 square is what?
656. 100.
656, 100. Multiply by probability of 0.35.
229.
229.
365. 635. Sorry. 635.
635. Then the next one, 15,000 minus 9,810.
How you did? 5190.
5190 square.
26936.
26,936.
100.
100. Multiply by 0.1. So this will be 2,693,610.
Okay.
Then the last one, 6,000 minus 9,810 will give us minus 3,810. Minus 3,810 square is what?
14,516. 100.
14,516, 100. Multiply by 0.2. That's 2,000,000.
2,903.
903.
220.
220. Therefore, you add up the last column. What do you have there? That's the variance. What do you have?
6741
6, 7,
41
4, 1,
900.
900. So that represents the variance. So all these ones are just workings. The next thing, the main requirement now says that we should, now before we move to the main requirement, let's calculate standard deviation once and for all. So standard deviation, which is the square root of variance. And variance is, of course, summation of probability of x minus x bar squared. Therefore, standard deviation will be square root of 6,741,900. So what do you have there?
Wait.
What do you have? Yes?
2596.5.
25967.
Okay.
2597.
Yes.
So we then go back again and answer the question as required. Number one, you have to calculate expected NPV. I would then say calculating expected net present value. So already we have calculated expected value to be 9810. So the next thing we need to do is to just calculate the expected NPV. So create a column for year, description of items, cash flow, discount factor. What's the cost of capital given? 10%, right?
Yes.
10% is the cost of capital. So here is 10%. Year zero. The useful life of the project is 6 years. So year 1 to 6. Here is initial outlay. Here is the expected value. Expected value, or just say cash flow. Don't start again. Use the pen. Cash flow.
Oh, you don't go ready.
Then in year 6, we are told that there's a scrap value of 5,000 naira. The expected value we computed is 9810. The initial outlay is 22,000, I think. Let me confirm. 40,000. Initial outlay is 40,000.
Hey, please, guys, sorry.
So here is one. Somebody should give me an annuity factor of year 1 to 6 at 10%. Annuity factor of year 1 to 6 at 10%. That's, what do you have? 1.1 raised to power 6 minus equal minus 1 equal divided by 0.1 equal 4.355. Then discount factor of year 6 at 10%. 1.1 raised to power 6 minus equal 1.1 raised to power 6 minus, that's
Ah,
0.564.
Mr. Juwon, please, can you help me with the annuity factor? I wasn't in class when you stated the annuity factor.
So when we did capital budgeting, you are not in class.
I wasn't in class.
annuity factor is calculated as 1 minus 1 plus r raised to power minus n, all divided by r. So 1 minus, open a bracket, cost of capital is 10%. So n is the useful life, which is minus 6, divided by 0.10. This is equal to 4.355.
Okay, thank you, sir.
Now, let's calculate the present value. 9810 multiplied by 4.355 equal, that's 42,723. 42,723. Then 5,000 multiplied by 0.564 equal 2820. 2820. You then get your NPV. The difference is 2820 plus 42,723 equal minus 40,000 equal 5543. 5543. So the expected NPV is 5,543 naira. So this is how to calculate expected net present value. The number 2 requirements, you are told to calculate the standard deviation of NPV. Standard deviation of NPV. And I told you that to calculate the standard deviation of NPV, the formula you are going to use will depend on whether you are given mutually dependent cash flow or independent cash flow. But in this particular question, since the cash flow given to us are mutually dependent, then the standard deviation of expected NPV will be calculated as follows. So you then say standard deviation of expected NPV equal to the standard deviation computed multiplied by annuity factor, multiplied by annuity factor. So we have calculated standard deviation. We've calculated standard deviation to be 2597. All right. We also calculate annuity factor to be equal to 4.355. Therefore, standard deviation of expected NPV will be equal to 2597 multiplied by 4.355. Give it to me. Final answer. What do you have there?
11,310.
11,310. So this represents the standard deviation of NPV. The last one, we are to calculate coefficient of variation. So calculating coefficients of variation. And I told you that the coefficient of variation, the formula to use to calculate coefficient of variation will depend on the standard deviation as well as the expected value that you have computed. So in this question, the examiner has asked you to calculate standard deviation of NPV. Therefore, coefficient of variation will be calculated as standard deviation of expected NPV over expected NPV, which is equal to 11,310 divided by 5543. Final answer is equal to what?
2.04.
2.04. So this represents the coefficient of variation. So that's end of the question. That's end of the question. Let me know if you have any question so that we can move to the next one. We are moving to sensitivity analysis. Yes.
Yeah, I have a question, sir.
Talk to me.
Just a very simple question. Because you already told us how you got the annuity factor of 4.355.
Yeah.
But the one of but the one of 0.564, I did not get how you.
You don't know how to calculate a discount factor. We have done it severally in the past, even under relevant costs for decision making. In any case, annuity factor, all right? Sorry, discount factor. Let me look for another place to put that. Now, discount factor is calculated as 1 plus R raised to power minus N. So in this case, we calculated for year 6. Cost of capital is 10%, therefore 1.10 raised to power minus 6. So that's what gave us 0.564. All right. If you want to do for year 1, it will be 1.1 raised to power minus 1. To do for year 2, 1.1 raised to power minus 2. So that's how to compute discount factor. Is it clear now?
Thank you.
Moses?
Yeah, very clear.
All right.
Sir, very clear. Thank you.
So let's move on to sensitivity analysis. Let's talk about sensitivity analysis. So let me use this material to explain it. Now, when you talk about sensitivity analysis, sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. Okay, I repeat, sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. All right. For this purpose, variables include initial outlay, variable cost, fixed cost, scrap value, sales volume, sales value, contribution, cost of capital, or project life. These are variables. Variables are those elements that make up the project being evaluated. Any variables that relate to the project, okay? All those elements that make up the project is what is known as variables. All right. So you want to know, what if the initial outlay increase by a specific percentage? Can the project still be viable? What is the extent to which the sales value can fall before the project will become unviable? This is what sensitivity analysis measures. It's also known as what if analysis. So you want to know what is the extent of change in any of the variables that will make the project to become unviable. That is what sensitivity analysis measure. And it can be calculated. Sensitivity margin can be calculated in 3 different ways, depending on the variable. For example, for all the variables, excluding cost of capital as well as the project life, sensitivity margin, let me write it out in full. Sensitivity. Okay, let me do it this way. Calculating sensitivity margin. Okay. SM. So to calculate sensitivity margin, like I said, there are 3 different formulas depending on the variable that you want to compute for. So for all the variables excluding cost of capital and the project life, sensitivity margin of variable will be computed as the net present value divided by the present value of the variable multiplied by 100 over 1. That's number 1 formula that you can use to do that. Then 2, if you have to calculate sensitivity margin of cost of capital, sensitivity margin of cost of capital. So this is computed as internal rate of return minus cost of capital divided by cost of capital. all multiplied by 100 over 1. And the last one, number 3, formula that you can use to calculate sensitivity margin. So sensitivity margin of project life. If you are asked to calculate sensitivity margin of project life, it's computed as the project life minus the break-even point of project life divided by project life, all multiplied by 100 over 1. So these are the relevant formulas that you can use to calculate sensitivity margin of variable. However, when you look at this last one, sensitivity margin of project life, you will notice that you have break-even point of project life. Therefore, how do you compute break-even point of project life? So whenever you want to calculate sensitivity margin of project life, the first thing you need to do is to go and calculate break-even point of project life. Therefore, let me show you calculating break-even points. Okay. What's wrong with you? Break-even points of projects life. How do you do this? There are 3 procedures you are going to carry out. Step 1, we are expected to reduce the life of the project by 1. Reduce the life of the projects by 1. For example, if the useful life of the project is 5 years, you minus 1, that's remain 4. Then step 2, we calculate NPV. Calculate NPV of the reduced life. Then the final step, calculates break-even points of project life using the formula below. So when you want to calculate break-even point of project life, so you say break-even points of project life equal to the reduced life plus the net present value of the reduced life divided by net present value of reduced life plus net present value of the normal life. All of this multiplied by normal life minus reduced life. So that will give you the break-even points of project life. So once you have this computed, you can then proceed to calculate the sensitivity margin of product life. So finally, notes. When calculating the sensitivity margin, of sales volume, the present value of contribution should be used as the denominator. Okay. So whenever you want to calculate sensitivity margin of sales volume, you use the PV of contribution as the denominator. Now, at all time, whenever you compute sensitivity margin, you must interpret your results. Whether examiner asks you or not, it's expected that you interpret your results. So there are 2 ways you can, for all the variables, there are 2 ways you can do it. So interpretation of results. Interpretation of results. All right, so there are 2 ways you can do this. Number A, for variables, such as sales volume, sales value, scrap value, contribution, savings, and project life. Then the interpretation should be that the variable, that is, any of the variables I mentioned above, the variable should not fall below the percentage attained. Otherwise, the projects will not be viable. So what this simply means is that if any of these variables, all the variables that you have here, if any of them fall below the percentage you have calculated, then the project NPV will become negative, which means that the project is not financially viable. All right. Then number B, for variables such as initial outlay, okay, variable costs, incremental fixed costs, cost of capital, okay, and cost of capital. Then the interpretation should be that the variable should not increase beyond the percentage attained. If not, the projects will not be viable. Okay, so that's the interpretation for the second one. So these are the two ways in which you can interpret your sensitivity margin computed. All right, so please master them. That's all about sensitivity margin. These are all the things that you need to know as far as sensitivity analysis is concerned. So the next thing we want to do now is to have illustration. Let's have illustration. Okay. Let's have illustration. So let's go back. Stop hearing this. Let's go back to the notes. Sensitivity analysis. Yes. So let's have illustration number 4. Who is helping us to read it? Quickly, who is reading for us? Illustration number 4. Moses, read.
Yeah. Okay. What page, sir?
Look at the screen. Illustration number 4. Page,
All right.
page 87.
87. All right.
Mississippi.
Mississippi Limited has sought your advice as a financial consultant on its investment proposal. It plans to diversify into the production of toilet soap. You are provided the following information relating to the proposal. The initial investment in plant and equipment will cost 4,800,000. The plants are expected to have a lifespan of 10 years with negligible scrap value. The company plans to maintain a minimum of 80% of installed capacity each year. At this activity level, 240,000 units are expected to be produced. The annual production overhead, excluding depreciation, is estimated at 360,000, while variable cost is planned at 18 naira per unit. The market research carried out favors setting the selling price at 24 naira per unit. The company cost of capital is 17%. You are required to A, advise whether the investment proposal is worthwhile. B, calculate the tolerable level at which the following can vary without any adverse effect on the investment proposal.
Thank you. So that is the question. Thank you, Moses. Yes, in the A part, you are to advise whether the investment proposal is worthwhile, meaning that you are expected to calculate NPV. So in the A part, you are to calculate NPV. In the B part of the question, this is very clear. You are to calculate the tolerable level at which the following can vary without adverse effect on the investment proposal. These are the variables given to you. So means examiner has told you to calculate tolerable level, which means that sensitivity margin. You are expected to calculate sensitivity margin of all these variables, of the 7 variables listed below. All right. So the A part, you calculate NPV. The B part, you calculate sensitivity margin. Certainly, there's no way, if you want to calculate sensitivity margin of variables, certainly you are going to need NPV. All right. So let me stop sharing this and move to the working notes quickly. All right. Solution. So illustration. I think that's illustration number 4, page 87. Illustration 4, page 87. All right. So the name of the company is Mississippi. Mississippi Limited. So the A part of the question, you have to calculate, you have to advise whether in the investment proposal is worthwhile, meaning that you have to calculate NPV. So I would then say calculating net present value. Our figures are in thousands. Okay. So create a column for year, description of items, cash flow, discount factor at 17%, then the present value. Year 0, we have the initial investments, which is 4.8 million naira. Discount factor of year 0 is 1, multiplied by 4,800, that's 48. The useful life of this investment is 10 years, so year 1 to 10. Now, in the question, we want to calculate NPV. In the question, you have been given selling price to be 24 naira, variable cost to be 18 naira. So you're also given number of units to be 240,000. Therefore, we need to calculate contribution. So let's go and do our working for contribution. Sensitivity margin, then working will be here. What's wrong with you? So working number one, we want to calculate contribution. To do this, contribution, you know, is selling price minus variable cost per unit. Selling price is 24 naira. Variable cost is 18 naira. Therefore, contribution per unit is 6 naira. So to now get the total contribution equal to units, the units sold, units produced and sold is 240,000 multiplied by contribution per unit of 6 naira. This will give you 1,440,000. So that represents the annual contribution. So let's go and post. So contribution 1,440,000. Our figures are in thousand. Then year 1 to 10, we also have annual production costs, excluding depreciation, which is, of course, here is production cost, which is 360,000. So somebody should give to me an annuity factor of year 1 to 10 at 17%. What do you have, please? In this class, it's only Moses that is talking. I have Jacinta, I have Mary Queen. Muibat, you are in this class. Oliver, you are, every one of you are in this class. Only Moses is talking. What's the annuity factor? Yes. What do you have as annuity factor? 1.17. Okay. Maybe I should do it myself since you are not ready to provide number. 1.17 raised to power, the useful life is 10 years, raised to power 10 minus equal minus 1 equal divided by 0.17 equal, that's 4.659. Here is 4.659, 4.659. So I need to get the present value. 1440 multiplied by 4.659 equal 6709. 6709, then 360 multiplied by 4.659 equal 1677. 1677 negative. So I'll then get the final answer, which is 6709. Okay. 6709 minus 4800 minus 1677, 232, 232. So the NPV is 232. Okay. So now that we have computed the NPV, I will then go to number B part of the question. Number B says you should calculate sensitivity margin. So I will say calculating sensitivity. You can see in the question, the requirements, examiner did not mention that you should calculate sensitivity margin, but it is implied because examiner wants you to calculate the tolerable level, which means sensitivity margin. SM. So we have about 7 variables. The first variable, number 1, I want to calculate sensitivity margin of initial investment, which is NPV divided by the present value of initial investment multiplied by 100 over 1. So in this case, the NPV is 232. The PV of initial investment is 4,800 multiplied by 100 over 1. So this will give us, I have 232 divided by 4/8 multiplied by 100. That's 4.8%. So you need to interpret this. This means that the initial investment can increase further by 4.8%. Any point above this 4.8%, the project will become unviable. That is, the NPV will be negative. So I need to interpret this. I would then say the initial investments, sorry, the investment proposal, initial investment, yes. The investment proposal, that is I should not increase beyond 4.8%. Like I said, Moses, please mute yourself. This 4.8% is what will make the project to break even. All right. If not, the investment proposal will not be viable. That is, if initial investment increase beyond 4.8%, the project NPV will be negative. Number 2, the next variable according to the question is production cost. I want to calculate sensitivity margin of production cost, which is NPV of 232, is the same formula, divided by the present value of production cost, which is 1677, multiplied by 100 over 1, equal to, so 232 divided by 1677, that's 13.8%. So this means that the production cost should not increase. The production cost should not increase beyond 13.8%. Otherwise, the investment proposal will not be viable. Number 3 variable is sales price. So sensitivity margin of sales price, which is computed as NPV of 232 divided by the present value of sales price. We don't have present value of sales price in our calculation, so we need to go and do the working. Working number 2, I want to calculate PV of sales price. So in this case, before you can get the present value of sales price, you have to calculate sales price, that is the sales value. So sales value is number of units of 240,000. 240,000 you multiply by selling price of 24 naira. So the total sales would then be equal to 5,760,000. Therefore, I would then say the PV of sales will then be equal to the total sales of 5,760,000 multiplied by annuity factor of 4.659. So this will give us what?
26,835,840.
26,835,240. That's the PV of sales price. So since our figures are in, is it 240 or 840?
840. I said 840, sir.
840. Okay. So since our figures are in thousands, so we have to restrict this one to 26,836. So this divided by 26,836 multiplied by 100 over 1. What do you have here? That will give you 0.9%.
0.9.
So this means that the sales price, should not fall below 0.9%. If not, the investment proposal will not be viable, will not be accepted. Okay, so that's it. So what this simply means is that this sales price, the selling price of 24 naira, you can reduce it further by 0.9%. So it is this 0.9% that will make the NPV to break even. So any point below this 0.9%, the NPV will be negative, which means it's not viable. Number 4. The fourth variable is sales volume. So sensitivity margin of sales volume. So like I told you, when you calculated the sensitivity margin of sales volume, the present value of contribution should be used as the denominator. So NPV is 232. Present value of contribution is 6709 multiplied by 100 over 1. So what do you have?
3.5.
3.5%. So here is 3.5%. So this means that this sales volume should not fall below 3.5%. The sales volume should not fall below 3.5%. Otherwise, the investment proposal will become unviable. So that's that. Number 5. Number 5 is variable cost. Sensitivity margin of variable cost, which is NPV of 232 divided by the present value of variable cost. We don't know the present value of variable cost. Let's go and calculate it. Working number 3. PV of variable cost. To calculate the PV of variable costs, of course, you need to first of all calculate the total variable cost. Total variable cost, which is number of units of 240,000 multiplied by variable cost per unit of 18 naira. So this will give you 4,320,000. Please confirm.
Confirm, sir.
Then, okay, so you then go further to calculate the PV of variable cost, which is equal to total variable cost of 4,320,000 multiplied by annuity factor of 4.659. All right. So this will give you 20 million 880. Our figures are in thousands, so it will be 20,127. So here will be 20,127 multiplied by 100 over 1. Give it to me. 232 divided by 20,127. That's
1.2.
1.2%. So this means that the variable cost should not increase beyond 1.2%. Okay? The variable cost should not increase beyond 1.2%. If not, the investments proposal will not be viable. Number 6, we are to calculate sensitivity margin of product life. Sensitivity margin of product life. Okay? Sensitivity margin of product life, which is computed as product life minus break-even point of product life, all divided by product life multiplied by 100 over 1. So in this case, we need to go and we know the product life to be 10 years, but we don't have the break-even point of product life. So let's go and compute it. Working number 4. Calculating break-even point of product life. Okay. So there are 3 procedures you are expected to carry out whenever you want to calculate break-even point of product life. The first procedure is to reduce the life of the project by 1. The life of this project is 10 years minus 1, 9 years. Step 2, calculate the NPV of the reduced life. Step 3, calculate the break-even point of product life. So let's try that. So we have reduced the life of the project by 1. Therefore, we calculate NPV for 9 years. Cash flow. Discount factor still remain at 17%. Then the present value. Year 0, year 1 to 9, 1 to 9. Initial investments. Annual contribution. Production cost. 4,800, 1,440, 360. Somebody should give me an annuity factor of year 1 to 9 at 17%.
4.451.
4.451. 4.451. So multiply. Multiply by, yep,
6,409.
409, okay?
Yeah, for production cost, negative 1,602.
Okay, so the difference will then be equal to 7.
Yes, sir.
The difference is 7 NPV. That's the NPV of the reduced life. All right, let me write it. NPV of the reduced life. So step 3 says we should calculate break-even points of project life. Therefore, break-even point of project life equal to reduced life plus NPV of the reduced life divided by NPV of reduced life plus NPV of normal life multiplied by normal life minus reduced life. So in this case, reduced life is 9 years plus NPV of the 9 years is 7 divided by 7 plus NPV of normal life 232. Normal life is 10 years, reduced life is 9 years. So 7 divided by 239 multiplied by 1, that's 0.3, okay, 0.03. Then plus 9, this will give us 9.03 years. That's the break-even point of the product life, 9.03. So I will then come here. This is equal to normal project life is 10 years minus break-even points of product life, which is 9.03, all divided by project life of 10 years multiplied by 100 over 1. This gives 9.7%.
9.7%.
Thank you. So you then say the project life, the product life should not reduce below 9.7%. If not, the investment proposal will not be viable. That's it. So the last one, sensitivity margin of cost of capital. Which is calculated as internal rate of return minus cost of capital divided by cost of capital multiplied by 100 over 1. Okay? So in this case, from this formula, you can see that we have internal rate of return. Therefore, we need to go and calculate internal rate of return first. All right? We need to go and calculate internal rate of return before we can complete this. So let's go and do working for internal rate of return. You must know what to do next. So this is number 5 working. Is it 5 or 4? Yes, 5. So calculating internal rate of return. And you know that when you want to calculate internal rate of return, you are expected to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a positive NPV. Another discount rate will give you a negative NPV. Then you interpolate. So first thing first, let's assume 20%. All right. Initially, we have calculated NPV at 17%. We got 232. So let's try 20%. If 20% is negative, then we assume that 17% as our second discount rate. But if 20% is positive, well, then we increase it to get a negative NPV. So first thing first, let's assume 20%. We then use this 20% to compute NPV. Cash flow, discount factor at 20%, then present value. Year 0, 1 to 10, 1 to 10. Initial investments, contribution, then production cost. Here is 4,800 negative, 1,440, then 360 negative. So somebody should give me an annuity factor of year 1 to 10 at 20%.
4.192.
4.192. 4.192. So multiply with the cash flow.
Yeah, for contribution, I have 6037.
6037.
For production cost, I have negative 1509.
1509. Final answer.
I have negative 272.
272.
Yeah, negative.
Okay, so 272 negative. So now that you have negative NPV, we can then proceed to calculate the internal rate of return, IRR. So in this case, we have assumed 17% as the lower discount rates. We also assume 20% as the higher discount rates. So there, internal rate of return is A plus NPV of A divided by the NPV of A plus NPV of B. All of this multiplied by higher discount rates minus lower discount rates. Okay, so equal. A is the lower discount rate of 17% plus NPV of that 17 is 232 divided by 232 plus NPV of the higher 272. Is it 272 or 273? This Moses, confirm the present value of the contribution once again. 1440 multiplied by 4.192, it should be 6038. Is it 38 or whatever?
The
41.
NPV is 272, negative 272.
272.
Yes.
Okay, let me see. Multiply by 1440. Okay, it's 6036 now. This one's supposed to be 6036, not 37. So because this one's supposed to be 273. Yeah. So 273 multiplied by higher of 20 minus lower of 17%. So final answer, what do you have? 232 divided by 505, is it 505? Yes. Divided by 505. Multiplied by 3 equal plus 17 equal. That's 18.38%. So you can say approximately 18.4%. So that's it. I will then come back here. So internal rate of return is 18.4 minus cost of capital of 17% divided by cost of capital of 17 multiplied by 100 over 1. So this is supposed to be equal to 1.4 divided by 17. What do you have? Multiplied by 100. That's 8.1 or 8.2. I think it's 8.2. Let me confirm again. So 1.4 divided by 7, sorry, not 1.4. Okay, 14 divided by 17.
8.2.
Pardon?
I said it is correct, 8.2.
Okay then, so you interpret your results. the cost of capital should not increase beyond 8.2%. The cost of capital should not increase beyond 8.2%. If not, the investment proposal will not be viable. So this shows that whenever, like I said, whenever you compose sensitivity margin, you have to interpret your results. You can see in the question, the examiner did not ask you to interpret. So if you don't do the interpretation, you can never earn your full mark. You have to interpret your result. Tell us what you mean by the figures you have computed. All right, so this is how to calculate sensitivity margin. This is purely sensitivity margin, sensitivity analysis. So that's it. So let me know if you have any question. Let's do simulation before we close the class. Yes, talk to me.
Look at the narration of the last one, as in the VI, cost of product life. You said the product life should reduce by 9%.
Should not. Oh, I wanted to say should not. It should not. Thank you. Should not reduce below 9.7%. Thank you. All right. So let me know if you have any question. So I have simulation for you before we close the class. So after simulation, we are going to do decision tree. After decision tree, then we have decision making under uncertainty. And that will be all. So we cannot complete everything today. All right. So, but let's have a simulation so that will reduce the time we are going to spend in our next class. So because we have only one more period to go. All right. So if there's no further question, then let me stop sharing this, or let me just use this material to explain it. Let me see if I still have space. This is moving to the last one. Okay. Let me do it this way. Simulation, decision tree, and then decision making under uncertainty. Okay, let's just do one more. I wanted to let's do one more. All right. So let's talk about simulation. Simulation. What do you mean by simulation? Simulation involves the process of mimicking a model in form of a real-life situation. I repeat, simulation involves the process of mimicking a model in form of a real-life situation. When calculating expected NPV using simulation method, the most important thing to do is to simulate for each variable of cash inflow and cash outflow, and then use the simulated result to compute NPV. Simulation method relies heavily on random variables. So the only unique feature of simulation is when you are given random variable, because the same way examiner will test question on expected value is the same way you are going to be given for simulation. The only difference is just that under simulation, you are going to be given random variables, but under expected value, you don't make use of random variable. So that's what I'm now saying, that simulation relies heavily on the use of random variables in calculating the expected NPV. Therefore, what are you supposed to do when you want to calculate expected NPV using simulation? There are two stages. There are two procedures you are going to follow. The first stage is to calculate, is to simulate for each variable. Step 1, simulate for each variable. So this variable include cash inflow and cash outflow. It could be revenue, it could be savings. Then the cash outflow could be variable cost, it could be running cost or maintenance cost. So what is important is that you simulate for both inflows and outflows. Then step 2, how do you then simulate? Let me show you. How do you simulate? To simulate, this is the format you are supposed to follow. You create the first column will be for the variable. Okay. After the variable, you introduce another column, which is the probability. After probability, you calculate the cumulative, you determine the cumulative of probability in percentage. Then you determine random allocation. This random allocation is just like class interval. Then the final column you are going to create is a random number. It can be called random number or tag number. Okay, either you call it random number or tag number. So whatever the case may be, so you put the variable here. It could be revenue or variable cost. Just put it there with the probability. You are the one that will determine the cumulative of the probability. You are also the one that will determine the random allocation. This random number given to you, you are the one that will assign it. Okay, examiner will surely give to you the random number or the tag number, but you are the one that will assign it to the relevant column or row. So this is the format for calculating for simulation. Whenever you want to simulate for variables, this is the format you are supposed to use. All right, then step 2, calculate expected net present value. So normal way you calculate expected NPV. So these are the procedures you are supposed to follow whenever you want to simulate. So at this point, that's the maximum. Now, one thing you need to know is that the expected value computed, let me put it down. Note, the expected value, let me write that. The expected NPV computed using simulation method. Using simulation method will not produce optimal solution. Will not produce optimal solution, but near optimal, in quotes, near optimal or good enough, in quotes, good enough solution. This is because not all cash flows will be considered. Not all cash flows will be considered. So in this case, you are selecting the cash flows randomly. You are selecting cash flows randomly. So you are going to leave out some cash flows. So as a result, you cannot have optimal solution. So this is what you need to know as far as simulation method is concerned. So at this point, let's have illustration, and that will be the end of today's class. Let me stop sharing this. All right. Let's have illustration that involves simulation. Yes. This is the last illustration. This is the last question tested by ICAN on simulation. So somebody should help us read it quickly. Who is reading it? Yes. Let me look at. Temitope, read. Temitope, read it. Illustration
Okay,
number
sir.
2.
The following probability estimates have been prepared for a proposed project. All figures are assumed to be correct. The company's cost of capital is 10%. You are required to A. Calculate the expected net present value using the following tag numbers. Again, the figures in the table are assumed to be correct. B. Explain any four merits of the deterministic simulation model.
Okay, thank you very much. So you have to calculate the expected NPV using the following tag number. Like I mentioned to you, now you can see that in this particular question, you are given probability. You are also given cash flows. Ordinarily, if not because of the information, additional information you are given in this requirement A, whereby you are given this tag number, ordinarily, what you are supposed to do is to just calculate expected value. Then you use your expected value to go and calculate the expected NPV. But examiner has told you that you should use the following tag numbers. All these ones are the tag numbers. Tag number is the same thing as random number. So that is the only thing that makes simulation to be unique from other expected value method. So in this case, what are you supposed to do? Let me stop sharing this. Move to the working notes. So to do this, I would then say solution. Solution to illustration. I think that's illustration number 2, page 86. Illustration number 2, page 86. The name of the company is not, is it given? No. We're not given the name of the company, so you ignore. So you want to calculate expected NPV. You have to calculate the expected NPV using the following tag number, that is using simulation. So I would then say, now, we say calculating the expected net present value using simulation method. Okay. To do this, there are 2 stages. The first step is to simulate for each variable of cash inflow and cash outflow. So, step 1, simulating for, I will then go to the question, what are the variables given to us? There are 2 variables, one is running cost, another one is revenue. So I will then say simulating for running cost. To simulate, the first column will be for the variable. In this case, is running cost. One thing about simulation is that if you are not in the class, or maybe you are not listening to the video, if you are just using class notes, you may not understand how the figures are gotten because you are selecting numbers randomly. So running costs, then probability, cumulative of probability in percentage. Then we have random, allocation. We have the tag number. Examiner has used tag number. You also must use tag number. So give me the running cost as given in the question. What was the first running cost?
500,000.
500,000.
600,000.
Okay. The last one.
700,000.
700,000. So give me the probability of each one.
The first one is 0.40.
Okay.
Second one is 0.20.
And the last one will be 0.40. The next thing is to find the cumulative of probability. You find the cumulative of the first probability is 0.4. In percentage, that's 40%. 40 plus 20 will give us 60. 60 plus 40 will give us 100%. Now, to get the random allocation, you are starting from 0, 0, 2. You are using the cumulative of probability to form the random allocation. So, starting from 0, 0 to 39. After 39 is 40. 1 minus 60 is 59. After 59 is 60 to 99. So we then go back to the question. For running cost, what are the tag number given for running cost? What are the tag number given for running cost?
There is
The first one is 20, 70, 52, 90.
52 and 90.
So you now look at your random allocation. Where does 70 lies? 70 is there.
Yeah.
Next tag number is
52.
52. Where does 52 falls? 52 is there. And the last tag number is what?
90.
90 will fall in the last row.
Yes.
So nothing goes to the first row. With this, we have simulated for running cost. You do the same thing for revenue. Simulating for revenue. Is it revenue or savings? Let me confirm. Revenue, okay. Simulating for revenue. So the first column will be revenue, probability, cumulative of probability in percentage, random allocation, then the tag number as given. Give me the revenue.
800,000.
800. Next.
1 million.
Next.
1.1 million.
And the last one.
1.2 million.
Give me the probabilities.
0.15. 0.40.
Okay.
0.20. 25 rather.
25.
And 0.20.
All right. Then the cumulative of the probability in percentage. So this then will be equal to, the first one will be 15%. 15 plus 40, 55. 55 plus 25, 80. 80 plus 20 will be 100%. You then use your cumulative for probability to form the random allocation, starting from 0, 0 to 1 minus 15 is 14. After 14 is 15. 1 minus 55 is 54. After 54, 55 to 79. 80 to 99. So we then go back to the question. What are the tag numbers given for revenue?
First one, 35.
The first one is 35. You now look at your random allocation. Where does 35 lies? 35 is here. Next one.
22.
22.
The same place, 22.
Yes.
Next one,
68.
68 is on the third row. 68.
58.
58.
58. You're correct, sir.
68.
So that's all. So nothing to the first row and the last row. So this is how to simulate. Now that you have simulated, the next thing you need to do is to calculate NPV. So the NPV you are going to calculate will be based on the set number as given to you, set by set. So you are going to pair revenue with running cost for each set. So I would then say calculating, let me come here. Calculating the expected NPV. Set 1. So create a column for year, description of item, cash flow, discount factor at what's cost of capital given?
10%.
10%.
At 10%. So year 0. What's the useful life of the project? What's the useful
5
life of the project?
years.
5 years. So years 1 to 5. So here it will be 1 to 5. 1 to 5. Set, of course, we have initial outlay. According to the question, initial outlay is how much? 800,000. So here is 800,000. Cash outflow, 800,000. Then we have revenue. We have running costs. So for set 1, pay attention, please. For set 1, what's the tag number for revenue? Set 1, tag number for revenue.
35.
35.
35. Look up. You now trace it to the left. Trace it to the left. 35, the revenue associated with that 35 is 1 million naira.
Okay.
So you then put the 1 million naira here. That's why I said if somebody is not in the class, you may not understand how the numbers are being selected. Then for set 1, what's the tag number for running cost?
70.
70.
70 will be in the last row, which is 700,000 naira. You trace it to the left,
Yes.
that's 700,000. Therefore, somebody should give me annuity factor of year 1 to 5 at 10%. I think this should be 3.791.
91.
3.791. So when you multiply, this is 3,791,000. Then the second one is what? 2 million what?
2,653,700.
53,700. Final answer.
Three 3,300.
3,373,300. So that's the NPV for set 1. We do for set 2.
Okay.
If you have 10 different sets, that means you are going to calculate 10 different NPVs.
Mr. Johnson,
Yes.
with what you just said now, is it possible or is there any short workings that we can use to compile or condense set 1 to
You're
10?
on your own. You're on your own. You are looking for shortcuts.
Shortcut is
There is no shortcuts. You have to you do it, compute your NPV step by step, the same way we
So
are
I just
doing it.
imagine this is a compulsory question.
Examiner
I'm
cannot
not
give you 10 sets. It cannot be that. I was just saying. Examiner cannot give you 10 sets. That would be too much,
okay.
especially at this level. So for set 2, item, cash flow, discount factor at 10%, then the present value, year 0, 1 to 5, 1 to 5. Initial outlay of 800,000 multiplied by 1, 800,000. Revenue, running costs. Now, for set 2, what's the tag number for revenue? Set 2.
22.
22. So that means it's the same place. Trace it to the left. That's 100,000.
1
Sorry,
million.
1 million. So here will be 1 million multiplied by 3.791, which is 3,791,000. Then running costs, set 2. What's the tag number?
52.
52 will be in the second row. Trace it to the left. That's 600,000. Here will be 600,000 multiplied by 3.791. What do you have? Yep. What do you have? 2 million. $3.791 multiplied by 600,000.
2,274,600.
2274
600.
600 negative. So plus 800 equal minus 3,791,000 equal
5265,600.
716,400.
400.
716,400. That will do for set 3. Here, item, cash flow, discount factor at 10%. Then the present value, year 0, 1 to 5, 1 to 5. Initial outlay, revenue, then running costs. 800,000 multiplied by 1, 800,000. Now, for set 3, the tag number for revenue would be
58.
68. So trace it to the left. You have 1.1 million.
Yes, sir.
Here is 1,100,000 multiplied by 3.791. Then for running costs,
It's
for
90.
running cost, 90. So 90, trace it to the left, that's 700,000. The cash flow is 700,000 multiplied by 3.791. So give me the present value, please.
For revenue, PV is 4,170,100.
170,100. Then here is 2653 700. Final answer.
716,400.
400. So we have computed NPV for the 3 sets. So you can see that we have 3 different NPVs. So, and you need only one. Therefore, you need to find the average expected NPV. So I will then say average expected NPV will be equal to NPV of the first one, of the first set, which is 337,300. 337,300 plus NPV of the second one, 716,400 plus 716,400 for the third one. So you add up everything, then you divide it by the 3 because you added 3 variables together. Final answer will be equal to, what do you have?
590.
590.
033.
033. So I can then say the expected NPV, the average expected NPV is 590,000. 590,033 naira. That's it. This is how to calculate expected value using simulation method. So let me know if you have any question for me. This is where we are going to call it a day. Now, like I said, we have one more period to go. So in our next class, by the grace of God, I'll be taking you decision tree. After decision tree, then we are going to decision making under uncertainty. Okay. Sorry. Yes, decision making under uncertainty. So that will be the last areas we are going to touch based on the risk and uncertainty. Then I can just brief you. We can just have a review or the discussions around the learning curve theory. Okay. So give and take. So in this case, so that we can we are going to have class on Thursday. Thursday is public holiday, May 1st. So we are going to have class. On scope in the performance management syllabus. All right. So let me know if you have any question before I close the class for today. Any question for me? Okay, so in the absence of no further question, I want to say thank you for joining the class. I will see you on Thursday by the grace of God. Bye-bye, everyone.
Bye-bye,
Bye-bye,
sir.
sir.
Bye.